Sorry.
Well, good evening, everyone, and welcome to tonight's presentation regarding insurance by Sanjiv Tidke. We'll be starting in just a moment to allow everyone to join. Well, it's great to see such interest in this important topic this evening. Just a few more seconds, we'll have a few more join us, and then we'll begin. All right, it looks like we're ready to go. So, good evening, everyone, and welcome. My name is Chris Malloy. I'm a senior advisor with TMFD Financial. The TMFD Academy is continuing a series of webinars that cover a variety of topics, both clinical and financial, that give back to the dental community. This evening, we're focused on a financial topic of great interest, personal insurance. This webinar will provide an overview of various personal insurance options and their significance at various stages of life, specifically with needs of dentists in mind. The topics will include living benefits such as disability, health, and critical illness, as well as short-term and long-term life insurance solutions. As we will see, the scope of various types of insurance is quite wide, and at times there could be the perception that individuals are being swamped with coverage. But the objective tonight is to provide an overview of the various types of coverage available so that individuals can prioritize and develop an insurance portfolio that is tailored to their needs and budget. I'll be introducing our speaker in just a moment, but first I'd like to hand things over to my colleague, Jake Giesler, who's managing the technology for us tonight, and to provide some housekeeping items.
Thanks, Chris. Good evening, everyone. Welcome again to the TMFD Dental Academy. My name is Jake Giesler, and I'm also an advisor at our TMFD Financial team. And as Chris said, I'll be running the technology in the background this evening. So before we get started, I'm just going to run through a few housekeeping items. First off, this webinar is scheduled to go to about 8:30 p.m. And if you have any questions for our presenter, Sanjiv, during the presentation, please feel free to ask them in the Q&A section at the bottom of your screen. They'll be answered throughout the presentation. If you have any questions for me, or if you have anything you'd just like to comment, just feel free to send a chat in the chat box. If during the presentation you're having trouble viewing our webcams or the presentation itself, there's a hidden view button in the top right corner of your screen, and it can be used to set the screens as you like. If this is your first TMFD Dental Academy webinar, welcome. You will be receiving a copy of our book, The Financially Independent Dentist. And please note, if you've already gotten a book, then you can't get a second one. It's just for the first timers. CE credits will be sent out within 2 weeks, no later than December 16th. And also feel free to look out for our next webinar on hygiene open time with Cindy Mark. That'll be taking place on Monday, January 23rd, 2023. I'll post the link to register for our TMFD Academy mailing list so you can be notified of all of our upcoming webinars. I'll post that in our chat box. But that's all the housekeeping items I have for today. So Chris, I'll throw it back to you.
Great, thank you, Jake. So tonight I'm very pleased and excited to introduce our speaker, Sanjiv Tidke. Sanjiv recently joined the TMFD as our in-house insurance specialist, but he has been supporting us for many years during his tenure as Associate Vice President of Estate Planning with Assante Estate and Insurance Services. Sanjiv brings both his technical knowledge and his enthusiasm to develop comprehensive insurance solutions for our clients. All right, Sanjiv, I'll turn things over to you now to educate us about the wonderful ways that we can protect ourselves and our families.
Well, thank you so much for this kind introduction, Chris, Jake. It's unbelievable feeling to join this team. I've worked with you guys for almost 10 years now, and I'm so glad that we are now part of this. I'm part of the same team, work on the same side. Not a lot of clients know that I've actually worked with the team for a very long time, many of the insurance solutions that many of our clients have procured from TMFT team. I've been a part of solution designs for those teams, and I've been the consultant to the team for such a long time. So I'm absolutely thrilled. Thank you for the opportunity. So my objective here today is to talk and give you an overview of insurance. To be honest with you, this is a learning webinar. There is nothing about sales over here. There is nothing which talks about giving you an advice about insurance in any shape or form. This is strictly from learning purposes. If there is an individual need, I would highly recommend that you speak with your relationship manager or one of our team members at TMFD to help understand more about insurance. My job over here today is to give you a quick and easy overview of different insurance solutions that are available at your disposal and which insurance solution may apply at what stage of your life. So, with that said, let's go to the news next slides and see what we got for you. So there are a few things that we will be covering. The topics probably would range at different categories of insurance, the stages of life, the overview of risk, insurance options. We'll do some case studies on over here, and then we take some Q&A. Now, first and foremost, we at TMFD believe that planning is the core of everything we do. And the purpose of insurance as part of planning is that it's a risk mitigation tool. That is basically what it boils down to. Now, when we generally talk about insurance, there are several categories of insurance. The first category that most people would understand and would relate to is what we call as living benefits. These kind of insurance are typically those insurance that you would claim on or you would rely on during your lifetime, be it in terms of getting coverage for health benefits or be in terms of getting coverage in the event you're not able to work or you get too sick to work, or in the case that you get diagnosed with a serious illness. Those typically form part of living benefit solution. The next category of insurance solutions is where life insurance comes in. Life insurance is the simplest and easiest of all insurance because we understand there is one payout, one event where an insurance contract is going to pay out. We probably are not going to focus too much today on life insurance, but we will have a quick overview of life insurance. The next set of insurance that we have that we kind of discuss, again, are wealth insurance product. Now, not a lot of clients know about wealth insurance, but yes, there are options available out there that could actually insure your wealth. So if you're concerned about, okay, there is volatility in the market, and I want to ensure that the money I deposit is guaranteed and is there with me for the rest of my life, or in event I pass away, yes, there is an insurance option available for that. Or if you are looking at guaranteeing your retirement income and you want to ensure that there is a stream of income guaranteed for life, yes, there is an insurance option available. Now, these three categories of insurance that we've talked about thus far fall under the life and accident and sickness insurance license that we have at TMFD. Per se, I'm licensed in the province of Ontario, Manitoba, British Columbia, Alberta, and help clients with insurance across these provinces. I am not licensed in the category of property and casualty, liability, and commercial insurance. Typically, these are insurance where you would see on home and auto, or for your commercial, for your practice insurance, or your general liability insurance, or insurance which pertain to slip and fall, as an example. So these are kinds of insurance that you typically would also need. As part of your overall practice, but these are insurance solutions that we are not covering today, and neither we are licensed to talk about it. But at the same time, they're important, and this should be evaluated by you at your disposal. So our focus, again, as I mentioned, living benefits is what we are going to focus on, planning at various stages, and a brief introduction to life insurance. So before we get into this whole stage of talking about insurance, we first need to understand that each one of us goes through different stages of life, depending on what we are pursuing towards our career, what we are doing towards our life, our goals, our purchase of business, and whatnot. Now, stages may vary from individual to individual. So, for example, for most of us on the dental fraternity side, we see that our clients by and large, a majority of them would first go to school, graduate, and take up an associate role in a practice. Now, an associate role as a dentist could mean that you are a dentist, but you're just starting out not as a business owner, but you've become part of somebody else's practice. You may be performing the dental duties that you normally would perform, but you're getting a share of the revenue from it, and you're not necessarily a business owner in that practice. So for that basically is where we see majority of our clients start. But we also see that this may not necessarily be the stage where everybody starts from. There are times that we have uh, graduates who start as dental hygienists, or they may be dental assistants. They've worked over there for a while, and then they go back to school, and then they come back as fully practicing dentists. There are times where we've seen that clients actually go through their graduation phase, they become a associate in their practice, and they remain associate in a practice for their entire career. So I can't really generalize that you would graduate from one stage to the other stage, but these are just stages that I'm talking about today, which will give you an idea that these are the things that do happen in life. Now, on the personal front, typically what we've seen that does happen is that, while you're establishing yourself on your dental side, there are things that happen on the personal side. Many of us going through our mid 30s typically get married. We may have children, and we typically end up buying our first house. Sometimes we don't get married, we do have kids, and we buy a house. And sometimes we don't necessarily have kids, but we do buy a house. And there are times where we just don't buy houses, we're just renting in perpetuity. So, again, I'm sorry if I'm generalizing, but there are times that you would see both ways happening. As such, or what we do see in many of our clientele is that as they graduate from that stage in life, they typically end up purchasing a practice where they become a business owner, and then they're working with multiple employees in the firm and helping a lot of our community towards their dental needs. On the personal side, you would see that families also grow. You start with one child, you may have more than one children, and or as your needs grow, so does your needs of living also grow. You may end up in a bigger house, may end up with a bigger mortgage, and things do happen. Over time, we also see that dentists actually progress and graduate from a single practice, sometimes into a more established practice. Sometimes we also see them that purchasing additional practices over time. So things do happen. These are, again, not necessary for every single individual, but we do see these happen generally. On the personal front, now we are approaching our early 50s and mid 50s, and we see at that point of time that our kids are graduating from universities, and now they're going on their own, and now retirement is calling. Now, per se, retirement may not be the right word. I personally feel that we generally never retire from things we love. We only find something if we only retire if we find something that is more attractive, or we love it more than what we did. And that's the reason why we find so many dentists who actually go on to work maybe in their late 70s as well. And things happen. I mean, I was just talking to Chris the other day about it. My doctor's pediatrician, she's actually 82 and she's still practicing. And she practices from 7 a.m. in the morning right up to 6 p.m. in the evening. And it's just unbelievable to see her dedication to what she does. And the reason why she does is she really genuinely believes and loves what she does. So, I mean, that's something common that we see across the board. And retirement not necessarily means that you give up something that you always loved. It's just that if you find something that you love more than what you did and you want to take that next step. What we do see in many of our clients is that when we use the word retirement, typically we see a sale of practice where they are planning to sell the practice, or they sell the practice altogether and work as an associate. Post that time, they're looking at spending a little more time in warmer weather, enjoy life a little bit better, and spend more time with family, something they've missed out on through their lifetime. They've been working very, very hard, and that's kind of the next stage in life that we see them. And then comes to the golden years of your retirement, where you just want to relax and take it easy. there on life does, as we age, there are other things that crop up where we do need some help and assistance. So these stages of life are important for us to understand because it gives us a good picture of where you stand in your life and what kind of risk solutions are out there. So from a planning standpoint, when we talk about insurance, excuse me, what we try to do is that we try to overlay the various risks an individual faces through their lifetime. So in the chart that you're seeing over here on the x-axis, we have your age put down over here. So we're going from age 30 to age 85. On the left-hand side, what you're looking at is that you're starting off earlier. Income protection is more important. So when I look at this and I'm thinking, okay, what are the risks I'm talking about? Well, we start of early in our career, the first thing that we're worried about is that, okay, if I get sick, if I get hurt and I'm not able to work, how are my expenses met? How are my family looked after? Or the next thing that most people would look at it is, okay, what happens if I pass away? Now, there's generally a misconception in many of us that we look at life insurance or we look at death and it's like, okay, this is the ultimate death. This is the only thing that we need to worry about. Or probably you'll think about something like life insurance when a bank or a lender would tell you that, okay, we are giving you mortgage to buy a house or we're giving you a debt to buy a business, you need to get some insurance. And that's probably the time that you probably would hear about life insurance or we would like to evaluate. True enough, yes, it's a risk, but as we go in the other side, we've done some statistical analysis to show you what various risks you face in your lifetime and the likelihood of these risks occurring as opposed to the other risk occurring. So in the earlier years, yes, there is a bigger risk that, okay, I may get disabled and may not be able to work. But at the same time, there's also risk concerning medical bills if I get sick. And there is a cost of recovery on that. There are times where people get sick with serious illnesses like cancer, heart attack, stroke. I mean, if you look at the statistics that are available, there are more people in Canada every year that are diagnosed with cancer, heart attack, and stroke combined than the number of people that pass away every single year. And it tells us that that would put an enormous burden on their financials to keep up with the cost of recovery on these serious illnesses. As we graduate through different stages or different ages of our life, we then understand that, okay, now that we've got more established, we have a established practice, estate planning, estate enhancement, and tax minimization becomes that much more important. It is essential to plan for your taxes appropriately. And that is why, I mean, we are so fortunate that we have planners like Chris Malloy that work over here, that work with you and help you with these strategies that will help you minimize taxation or plan effectively. But as we graduate into the older age, assisted living could become a bigger challenge. And as you must have seen during COVID, we've seen this happen where the fact or the thought of living in a long term care facility itself has become the biggest scare because of things like COVID and flu that could happen, could transmit from one long term care facility to the other long term care facility. And individuals these days are really worried that they do not want to spend their last years or their final years into a long term care facility for the same reason. Now, here comes the likelihood of risk. Now, there are different kinds of risk that we face, but what I've tried to do over here in this slide is that I've plotted the likelihood of an individual passing away prior to age 65 or getting critically ill with a serious illness like cancer, heart attack, stroke, or the risk of getting disabled and not being able to work. So this chart over here is between age 25 to age 50. Now, I certainly understand this chart should have been longer and I apologize, but what I've tried to capture the essence of is that we're trying to look at, okay, in the prime years of my working, which may be between age 25 to age 50, what is the highest risk? What we really see is shocking, and you would find that on the chart. The bottom line over here actually shows you the risk of you passing away prior to age 65. This chart over here is for male non-smoker. Now, at age 25, you may be stunned to know that the risk of this individual passing away prior to age 85, 65, I'm sorry, is just about 7%. If we compare this with the same individual risk of getting disabled, they are 3 times more likely to get disabled versus passing away, or they are more than 4 times likely to get sick with a serious illness. Now, I would be doing a really poor job if I come to you as a risk planner and say, well, you know what, life insurance is the most important thing, and we should be focusing only on life insurance. And that's probably not we do over here. And that's the reason why we're trying to do and compare this. The stats are no different for women. Yes, women have the edge over men. They live longer than men. Their probability of passing away prior to age 65, if computed at age 25, is much lower than men. And we do know statistically that women outlive men. But women's body undergo a lot of more changes as opposed to their male counterpart. And for that reason, they have a higher probability of getting sick with a serious illness or getting disabled prior to age 65 as compared to men. So, in both the cases, we see whether it's a male or a female, the chances of getting sick with a serious illness are a lot more than their chances of passing away. And disability in both cases, whether it's male or female, is a very, very important topic to consider. So it brings us to a first trivia question. In terms of likelihood of risk that you have, which risk has the least probability of occurring prior to age 65? So I'm talking about the least risk, not the most risk, the least risk. So Jake, if you could help us get a poll question for this one, be awesome. Okay, give it a few more seconds just to get the answer. All right. Premature death. Almost 95% of you have rightly answered this question. It is the the lowest risk that an individual faces. And half the times I'm surprised when we see new prospects would come and they'll talk. They're like, well, we just need life insurance. We just want to talk about life insurance because that's what the bank has done. And I mean, I try to put myself in your shoes and think that, okay, you have a patient who's come to you and says, I have a toothache and I should get my teeth cleaned. And I think I need to get some polishing. Probably that would do the job. And my neighbor did that too. And that's what he said. And you kind of wonder at that point of time that, okay, who's diagnosing whom over here? Who's doing the job? I mean, I've been given a job to help assist you. I would probably go out there and tell you that maybe these are the things that you may want to consider. So thank you for answering those questions properly. All right. So overview of living benefits. So the first thing that we're going to talk about in living benefits is disability insurance. And why do we need disability insurance? So disability insurance is a product or a solution which is designed to protect your biggest asset. Your ability to earn income is your biggest asset. I mean, just to give you an example, if we consider a 30-year-old individual who's starting at, let's say, an income of about $100,000, and if we index that income, say this individual is going to work to age 65 or to age 60 for that matter, I'm sorry, and if I sum it up, probably get a number of $6.3 million worth of income that this individual is projected to make in their lifetime. It could be much higher if I consider that, well, maybe they start off at $150,000. It could all depend, depending on what specialty they've done, whether they're a general dentist, whether they're a hygienist or they're a dental assistant. It could totally vary. I totally understand that. But just to give you an idea, if somebody started off at 150,000, by age 60, if we index the income by 3%, they stand to make close to $9.6 million. So your biggest asset is your ability to earn income. That's what disability insurance is out there for. The biggest thing that we need to understand is that disability not only can disrupt your personal income, it can also disrupt your business. Now, take an example. You're working, you're doing good, you have an established practice, or maybe you're working as an associate, which is great in your earlier years. But if you have an established practice and you're the business owner, you get disabled. Sure, you have a disability insurance that is paying for your income, which is great if you have. But then consider your business on this side. You're disabled, you're not here, you're not taking care of the business. How's the business going to run by itself? That sometimes becomes a challenge. And that's why disability for an individual is a big risk, not just personally, but also for your business. Sometimes when you look at the continuity of the business or business valuation, it becomes a really big challenge because we know the valuations of most dental practices out there is based on the revenues that the business is able to generate. Without you working over there actively, it could be really very difficult. If you do not have business continuity plans in place, or you don't have proper associates, or you don't have proper dental partners in place, it may be very difficult to sustain that business in the event you get disabled. Oops, sorry, did I move to the next slide? My bad. Okay, yes, I had to move to the next slide. Sorry about that. Okay, so what are the key elements of planning for disability insurance? Ideally, what we would recommend is that if an individual needs to consider disability insurance, they should ideally start right after they graduate. There is a reason why we say that. Typically, most disability insurance companies out there, including RBC and Canada Life for that matter, will provide a graduate discount to students. And what they also do is that if you've taken this graduate discount and added on some future options to get additional disability in future, then that discount also carries over to the additional insurance that you would buy in future. So that is kind of an important thing. And that's why I felt this is something that you should have right after you graduate. But if you did not have it after graduation, it doesn't matter that you would not be able to get it. It's just that you don't have those graduate discounts available. Now, broadly speaking, there are two types of plan. There are professional disability insurance plan, and then there are blue collar insurance plans. And one thing that we really uh, promote over here and talk to our clients about is that you don't necessarily need to look at a brochure of a product, but you really need to pay close attention to the legal contract. Because on the brochure, a product may say, yes, it's a disability insurance and we will pay you a benefit in the event you get disabled. In reality is, okay, what is the definition of me getting disabled? We were looking at a contract the other day. The contract said, hey, we have an extreme disability benefit, which is built into our life insurance by default, and you get this for free. And our client was really happy and it was like, okay, this contract only costs $50 a month, and I'm getting this $125,000 of disability. The definition of disability in this contract was called extreme disability benefit. And the time or the only event you can claim on that disability on this crazy plan, and sorry for my language over there, but uh, was that due to an accident or an illness, you are unable to perform four activities of daily living, is when we will consider you as disabled. And you have to be in a state of permanent and irreversible that this claim could be made. So when we talk about four activities of daily living, it means I'm not able to get up from my bed. I'm not able to bathe by myself. I'm not able to feed myself. I'm not able to wear clothes. I'm not able to transfer my body from one place to the other. I'm not able to use the washroom. These are your six activities of daily living. So for an individual not be able to do four activities of daily living is an extremely brutal definition of disability. So please, when you work with your advisors, please pay close attention. Sometimes these brochures can be very difficult. There are disability insurance for blue collar plans available out there that only cover you for an injury. They don't cover you for sickness. So The professional plans that are available in the industry, and I'm not going to talk about any specific product today, nor give you any pricing, not plan for a disability insurance per se, but just give you generic idea because this is a learning platform and you're here today to learn about it. So that's my job over here. So most professional plans that are available from RBC and Canada Life for that matter would ensure that these contracts are there with you from now to age 65, sometimes to age 75. The wordings of the contract cannot be changed. The definitions of the contract are typically based on your inability to do your job, that you are under the supervision of a physician. The premiums of these products are typically guaranteed. Those premiums cannot be changed by the insurance company, and the definitions cannot be changed by the insurance company. Certain blue collar plans are not designed that way. That's because the risk taken by those blue collar plans are more geared towards clients who do not make that sufficient income to kind of have a full blown plan. Number one. Number two is that their risk of getting disabled is much higher. So if I were to compare the risk of a construction worker or of a truck driver who's on 401, 8 hours a day on a tractor trailer versus comparing that to an individual like myself who's working in an office, who's in front of the computer, and probably travel less than an hour a day is much, much lower for me versus them. So there are two different kinds of them. The other important aspect is what we see as the occupation definition. Almost always, when we're working with our dental professionals, we'll typically say that you should use own occupation. Now, recently, there has been a change. And Manulife used to be pretty dominant, pretty much had a monopoly in this business of disability insurance because they offered own occupation to our dental clients. What most people did not know is that Canada Life also offered and still offers own occupation. So we do have own occupation that is available for our dental clients. It's just that Manulife used to provide a 4A occupation class, which was the highest occupation class with lowest cost available, versus Canada Life that provides a 3A occupation class. So there is a slight difference, but this own occupation is still available. There are other occupation definitions too, which are regular occupation and any occupation. Now, regular occupation and own occupation are pretty similar in terms of the wording, with the exception of. So there are three items that an insurance company will look at in the event in the event you're disabled. They first would say, are you capable of doing significant duties of your job? Keep in mind, they're saying significant duties of your job. They do not say all the duties of your job. It's significant, not all. Number one. Number two is that are you under the supervision of a physician? You almost always will be under the supervision of your general physician in the event you get disabled, because periodically you would want to go to your physician to get yourself checked to see if you're capable of working or not. For us, most dental clients that we work with, we've seen that even if they're sick, sometimes they would go and work. I mean, that's just the part of being a business owner, because you want to run your business, you're working, and that is just how it works. But that's the second thing they see if you're under the supervision of a physician. The difference between regular occupation and own occupation is that in own occupation, the questions stop right at these two. Are you doing capable of doing the job that you were able to do prior to getting disabled, or you able to do significant duties of your job, and that is just prior to getting disabled? And if you're under the supervision of a physician. So maybe because of an accident or an injury or because of a sickness, you're not able to do your dental job, but you're still running your dental practice. That would still qualify you to get your disability benefit. In the terms of regular occupation, there is a third element. The third element is, are you involved in any gainful activity? Now, we do know that as business owners, you are running a business and there are other elements of your business, maybe on the hygiene side, maybe on the other side, that you are not necessarily doing it yourself, but you have hygienists or you have dental assistants taking care of that part, and that revenue would come. So on regular occupation side, it could become challenging for a dental specialist or a dentist, a general dentist to claim on that. That is the reason why we talk about own occupation all the time. There is also a third definition of occupation for disability called any occupation, and we highly recommend that you should be careful about this, because what any occupation does is that it measures your ability to do any job for which you have experience or you're educated enough. And that any job could be absolutely any job. It doesn't have to be in the field of dentistry. It could be a merchandiser at a Shoppers Drug Mart. It could be flipping burgers at McDonald's. It doesn't matter. As long as you have the education and the know-how that you could do it or you could be trained for, then the DI would not be payable. So we have to sometimes pay very close attention to these definitions of disability. Now, there are times that uh, an individual would say, well, I'm disabled and I'm not able to do altogether anything altogether. That's what we call as total disability, and where there is 100% payout. But there would be other times that you are sick or you are injured and you're not able to do all of the duties. You're able to do some duties, in which we may see an loss of income. If we see a loss of income over there, there are two categories over there. There could be a loss of time and loss of income. So residual disability typically is a definition that is baked into a lot of contracts, which would pay if your income loss is more than 20%. Partial disability, on the other hand, is a fixed payout of 50% for a set amount of time. Partial payout is typically where you have to prove loss of time. Now, most people know total residual and partial disability. There is something called as catastrophic and presumptive disability as well. Catastrophic disability is that because of an illness or an injury, you are unable to do two activities of daily living. And then you presume that you're disabled and there is no waiting period, they will pay you out. Presumptive disability is the disability where, due to an accident or an illness or an injury, you have lost the use of your hands, your limbs, your sight, your speech, your hearing. In any of those events, again, it's assumed that you're totally disabled and there is a full payout. Most disability insurance contracts have an elimination period. An elimination period is basically a duration in which the insurance company has kind of looked at your file, you've been deemed to be disabled and you're not working. But in that first 60 days, 90 days, or 30 days, whatever you choose under the plan, a disability benefit is not paid. The insurance company wants to ensure that a payout is done post that elimination period. And that elimination period sometimes also gives us an opportunity to lower the cost of insurance. If we make a disability insurance plan with a 30 days elimination period and we compare that plan with a 90 days elimination period, sometimes we see the cost difference could be 60-70% of extra on the 90 days elimination. So that's something which is really important. Benefit period on a disability insurance is important. You may want to have a coverage for a plan that goes right up to age 65, for that matter, to ensure that your entire working period is covered. Coverage amount again depends on an individual's income. Now, it's loosely said in the industry that disability kind of pays 66.6% of your overall income. It's not 100% true. For an individual that's making $25,000, $30,000, that disability payout ratio could be 80%. And for an individual who's making $1 million, that disability payout ratio could be 40%. An insurance company typically tends to include something called as an incentive gap. Basically, they want to ensure that the disability benefit that you get once you become disabled should be less than the income that you were making prior to getting disabled. That gap of income prior to getting disabled, they believe will incentivize you going back to work. Now, there are certain other riders that we would typically recommend. One is future insurability, because we see that most individuals, from the time they start their occupation to the time they retire from the occupation may have a significant income gap. It does happen. You start off new, don't really have much experience, you probably don't own the business, you are learning yourself, and the place that you go to work would help you train, learn the business, understand the art, would pay you much lower income. Once you graduate into something better where you know what you're doing and you're running your own practice, you're running your own business, your income is much higher. So that's kind of where we want the future insurability, so that even if your health changes and you're not able to qualify for more insurance because you're not healthy, this future insurability rider helps us get insurance at the same standard health status that you had when you applied for originally. The rates of the future insurance will be higher, of course, because you're now much older, but you have the option of buying more insurance without providing them the medical evidence. The next part is the cost of living adjustment, COLA, which is for inflation protection. I mean, it's needless to say, we've all seen what has happened in past 2 years. We are all reeling with the impact of inflation right now, and it's a really important rider to have. So that's something which we by default would almost always tell our clients to have in their plan. There's another very important rider which is called the healthcare profession rider. Now, the healthcare protection rider is important for three communicable disease: hepatitis A, it's hepatitis B, hepatitis C, and HIV. Now, the challenge that is posed by these three communicable disease sometimes, and that is a perception right now, it's yet to be proven though, is that if you get these communicable disease and if your regulatory body or your licensing body or your dental association says that you need to disclose this to your patients, and your patients stop coming to you because they don't want to get treated by you because you have this communicable disease, then a payout on disability is done. That's what this healthcare profession rider is for. Now, Manulife, Canada Life, RBC, each one of them has the definition of a healthcare profession rider slightly different in their contract, and that's where we have to be careful in picking one over the other. Now that Manulife is not there in the picture, Canada Life is there, and RBC is there, we find that Canada Life's definition is slightly better than RBC's. The next option that we have on the table is the 50% return of premium rider. Now, this option is available in the event you get a disability insurance. You've not claimed on the disability benefit for next 8 years for that matter. In the event you haven't claimed 50% of the premiums that you've paid to the insurance company, they come back to you. That's basically your 50% ROP rider is. There are many more riders depending on the insurance company that could be there, and each case is different. So when we work with you, we try to tell you, okay, these are important elements of disability planning. You probably want to see it. Having said that, there are actually 5 kinds of disability insurance that are available out there. The first type is the personal disability insurance, which is to protect your income. You get disabled, you're not able to work, and you get an income. It's typically owned by you. You pay for it from your after tax income and you get a tax free benefit. Sorry. There are other options, sometimes called as wage loss replacement programs, where we have a group of individuals who are part of the same practice. And instead of getting you individual disability, these are grouped together to get you a much higher benefit. But these benefits, which are higher, are taxable because the corporation is paying for the benefit. They deduct the premium. So it's paid through your corporation. Premiums are deducted over there, but the benefit that you get at time of claim becomes taxable. It's a different kind of plan, but again, the idea and the direction is exactly the same. So there may be a gap of 25 to 30% in the benefit on the wage loss replacement program versus the personal disability insurance, but on one side the premiums are deductible, the other side the premiums are not deductible. And again, it's on a case by case basis, because certain dental practices may not have that many individuals that we could do this for, and there are certain times where we would suggest that it just doesn't work that way for you. You're probably better off. There are times where we have multiple dentists in a practice, and we have a bigger practice, and in that case we could do a group DI. And the benefit of a group DI is that because there are more number of people, there is a discount available to each member. There are non-medical evidence, non-evidence-based products available, so they could offer you a DI without asking medical questions altogether. That is an option, and that's sometimes a benefit of group DI. Now, all of this that we spoke about thus far has been only towards protecting your personal income. What happens to your business? Because I spoke to you earlier on and I said, okay, well, hey, um, your business may not be working that well in the event you get disabled. So the first insurance that's available is called the business overhead insurance. Now, disability overhead insurance is typically owned by a corporation. The corporation pays the premium, deducts the premiums as an expense. In the event you pass away, the not pass away, I apologize. In the event you get disabled and you're not able to work, the overheads of the business are covered. So you may be wondering, okay, what kind of overheads are covered over here? Well, overheads including your rents, your lease, sometimes interest payments on capital goods that you had purchased through financing, even that is covered. The salaries of your staff are covered. The salary of you or your spouse, which are associated with you, are not covered by business overhead insurance. Capital goods are typically never covered by overhead insurance. Consumables are typically never covered by business overhead insurance, but it does cover a lot of benefits. At time of claim, in the event you have got disabled, business overhead is typically a reimbursement of uh, claim, or it's a reimbursement of the expenses that you've already incurred. So at time of claim, you have to go to the insurance company and prove that, okay, here are the expenses that we have paid, and we have this disability insurance to cover our overheads, and a payout is done. So that's basically disability overhead. There is also something called as disability loan protection, and it's just outstanding to see the number of practices that are purchased using a business debt. Now, if we just don't consider this insurance altogether and we're just thinking about, I got disabled, I can't work, well, I'm getting my income. Well, keep in mind, the bank that has extended you $3 million worth of loan to buy that practice is expecting that their debt is paid off. Um, at the minimum, their interest on the loan is taken care of. So what this loan protection does is that in the event you get disabled and you're not able to work, that business loan is taken care of. There is a payout that is done and the loans are taken care of. The tax status or the nature of deductibility of the premium will depend on where it is owned, whether it's owned personally or whether it's owned inside the corporation, whether premiums have been deducted of it. For this, on the personal side, then the payout becomes taxable. On the corp side, almost always this is a reimbursement, and the benefit payable becomes taxable because you typically deduct the premiums of it. There is a disability buy sell insurance, and this is kind of very interesting in the essence that we do see times where we have more than one dentist as the business owner. So we have two, sometimes we have three dentists who own a mega practice. It's a big, large practice, or it's a chain of practices that they own together. Now, one of the key things that we talk about is that, okay, when you are working as a business owner, you have expenses that you're working every day. There are revenues that you're trying to bring in every day because you have to justify those expenses. There are so many people who rely on you for their employment. So there is some responsibility that you have on your shoulders for that. Now, in the event one of the partners is disabled, now we have two partners who are working and they still have to pay the disabled partner and still continue the business. Now, there's a loss of revenue over there because the disabled partner is not contributing. So we need to have something in place to kind of help out. In many cases, when you look at shareholder agreements or we see buy sell agreements, which are put in place by lawyers when you set up corporations, we find that many lawyers these days talk about disability buy sell. That is, in the event you have a permanent disability and you're disabled for a period more than 365 days, then your partners have a right to buy out your share of the business. Sure, the partners have the right to buy out. They need to have cash in their pocket or have financing available at that time to buy out your share. That is where disability buy sell insurance comes into play, which provides you the cash flow or the liquidity to buy that. There's also a disability key person protection that is typically put in place for key employees of the organization. So you have a dental practice and you rely on certain key people in the organization because those key people may be responsible not just for the key activity, they may be responsible to generate business for you, to get more clientele. They're the ones who have the contacts, or maybe they're the ones who are non-dentist professional who are part of your corporation, but they're the ones who are controlling the entire operations. Sometimes it becomes really very important to ensure these individuals as well. So the next item that we have on the agenda is health and critical illness insurance. So health insurance and critical illness insurance is something that we're going to have a little deep dive into and try to understand what these insurance do. Many of us understand that most of our clients who are working, and I'm not talking about my dental clients over here, I'm talking about every individual out there that is working with an organization today and has some kind of group benefits. Now, these individuals are able to pay our dental expenses, come see a dental hygienist or see a dentist for that matter, is because they have some kind of group benefits at work. Sometimes they don't have group benefits, they may have an HSA. Sometimes they personally have insurance to cover for those expenses. So that insurance is actually called health insurance. That one typically covers individuals for prescription drugs, for semi-private hospital, for dentists, for physiotherapists, chiropractitioner, for vision, for ambulance, and a whole host of stuff. Again, these insurance are important because at the end of the day, there will be medical expenses that would come. We know that is just the nature of things. That's the nature of our human body. Things happen. We do get sick, and that is where this insurance comes to play. Critical illness insurance, on the other hand, is a insurance for life-threatening illnesses like cancer, heart attack, stroke, and there's over 25 of them, and we'll talk about it in a little later. So we are reaching into the next question that we have, and we are talking about what is typically the individual's biggest asset. Now, if you've heard me speak about this one earlier, I did allude to the fact that there is an asset that an individual has that is the biggest asset. I don't know if it's a car or a cottage or the ability to earn income. That's a question to you, but here's the opportunity to vote and tell us the answer. All right, I am so pleased to say that 100% of participants got it right this time. It is the individual's ability to earn income. Thank you, Jake, for helping out on this one. All right, so now you're going to learn about health insurance. I hope you're still with me because I know this is getting really technical and we are talking about a lot of stuff over here. But typically, most individuals need personal health and dental insurance. Now, it may not be personal health and dental insurance, it could be something that they have as benefits, or it is sometimes they don't have benefits, then they have to go out and buy. So, what are the key characteristics of this? Typically, personal health and dental insurance is medically underwritten. And when it is medically underwritten, it tells me that it is for something which is unforeseen in future that may happen. But if you have a pre-existing condition, then most likely that would not be covered by these kind of plans. That's why I would say pre-existing conditions are typically never covered by a fully medically underwritten personal health and dental plan. There are Having said that, guaranteed issue options that are available, but when we look at the amount of coverage that is there is very, very limited. Sometimes when we do the math, it's like, oh, I'm gonna pay about 2,500 as premiums into this. I'm probably gonna collect $2,500 at the end of the year in all of the medical expenses put together. So is it worthwhile? Well, uh, we'll have to sit, analyze. Every case is different, and probably there may be other options that we may be able to look at and consider. But just to give you an idea, something like this exists. But for the most part, you would find that a lot of individuals that use your service as dentists for all the various services that you offer typically have group benefits. It is typically for incorporated business owners. So, incorporated business, whether these are small business, private corporations, or they're publicly traded company, group benefits is an option that is available to most businesses. Businesses can pay for this, the employees can have it, and we'll talk about it in a little bit, including yourself. You as business owners, you have your own staff, you have your own people, and dentals is not uh, dentistry is not the only expense. There are other medical expenses that are there that need to be covered, and group benefits is a perfect way to provide. One of the biggest benefits of group benefits is that pre-existing conditions are covered. So it doesn't matter if an individual has a health condition or they don't have a health condition. Both individuals are treated exactly the same. The third type of health insurance that we've seen, well, it's kind of not health insurance, but these days there are elements to it which actually have made it more appealing. And like in health insurance, is the health spending accounts. Typically, they're never medically underwritten, pre existing conditions are covered. The biggest benefit that we find in a health spending account is that the limits that a business owner can set towards medical expenses or towards specific expenses on medical side is really very, very generous. We typically find that those benefits, so for example, on the group benefit side, it'd be very hard to find a group benefit plan which would cover 100% on braces. It's typically very, very rare to see plans that'll cover $2,000. I mean, you're lucky if you're getting covered for 1,500 for that matter. But when we're looking at a health spending account, it just doesn't matter. It could be the whole $8,000 that you spend for braces, all of it can be covered. So it's totally a very flexible way which is available for business owners, and it's actually a very tax efficient way. When we go look into it, there are options that are available. The best part is that these days there are options of insurance. So typically, a health spending account is set up by a corporation with a third party administrator, and it's basically claiming on um, medical expenses by shareholders or the employees on this plan. It's a cost plus mechanism, and there's no insurance component to it. So it's like, okay, well, we had $10,000 claim, we submitted the claim, the corporation had to add extra as the admin fee for the third party administrator. We've ended up spending $12,500, and that is it. But if a catastrophic claim comes in, there's no insurance typically on a health spending account. Good news is that there are certain newer HSA options that are available, which actually have catastrophic insurance built into them. And we'll talk about them in a little bit. Now, the first element that we talked about on the benefit side was group benefits, and it is actually a very good recruitment and employee retention tool. I can't tell you the number of times I speak with my friends, and number of times I've spoken with clients on their new job or the new venture that they've started and whatnot. Most of them would not talk to you and tell you about their salaries or remuneration, but the one thing they would almost always say is they've got great group benefits, or they have bad benefits, or they have good benefits. You will almost always hear, even if your kids go work with an organization, the first question that you typically asking them is, of course, we want to make sure they're financially well off, which is really important. But at the same time, uh, are they giving you group benefits? That's kind of important question. And this is why it's important for you to know this, because you are running a business, you have staff, and your staff is in high demand. How do you retain your staff is a question sometimes that you face in your own organization, in your own practice. So That's where group benefit comes in. There are typically 7 elements to this. I mean, life, accidental death and dismemberment, spousal life insurance, those are basic stuff. We all understand. The key elements that actually come up is, okay, how much drug coverage do we have? What kind of extended healthcare do we have? So we're talking about physio, chiro, semi-private, ambulance, vision, those kind of stuff. Then we're talking about stuff like dental. Okay, if you're talking about dental, what are we talking about? Basic, preventative? Are we talking about major? Are we talking about orthodontics? How much is covered per year? Are there any wait times for it to start? What's the recall? Sometimes there are recalls with a plan. There may be a 9-month recall. There could be a 6-month recall. There could be a cap on number of units that you get per visit or for the total year. So it just boils down to how the plan is structured and how generous you want the plan to be. Short term and long term disability are two important elements. Now, these are certainly a tool for you to mitigate your own risk. If you have an employee that gets disabled and is unable to work, um, do you how far do we go as far as limiting our liability towards that individual or to protect our business? Because sometimes it's just a hard fact or a hard reality of life that um, desperate people could sometimes make desperate decisions, and those may not be the most wise decision, and it may sometimes lead to litigation. So uh, long-term and short-term disability sometimes help mitigate those risks, because an individual is disabled, they're unable to work, there's a perfect place for them to claim on it, and they can have their remuneration done on that, and an insurance company is dealing with that aspect, and you've totally that risk out of your domain into the insurance domain and let them take care of it. For the most part, group benefits are owned by corporations. So the corporation owns it, corporation pays for it. It's a deductible expense for most elements, not all the element. If the corporation wants to deduct premiums for everything, they can by all means do that. But typically, health and dental, EHC are tax deductible at your end. The benefit paid to the employees when they claim or the shareholders when they claim is tax free. Short-term disability, long-term disability, life, accidental death, these are typically required to be paid by employees to ensure that at time of claim, the benefit is tax-free. Now, employers do have an option that employees can participate in the payment of these plans. We've seen certain organizations have a 50-50 share. Now, it all depends on the cash flow of the organization, profitability, and sometimes if you've purchased a practice and they've had a plan for past 15 years and that's how it is, then it'll be probably difficult for you to kind of go in and change and have a split payment. But just keep in mind, there's always an option to include. On the premium side, one thing that you want to know is that group benefits typically never come with contractually guaranteed premium for life. Those premiums are there for probably 12 months. Sometimes they're there for 18 months and they're fixed and then they may change. And we all know that medical inflation is a lot more than regular inflation out there. And that's typically the reason why you would see claims to be not bound. One of the key things that is important to keep an eye on the group benefit side on the premiums is that at time of claim an insurance company is looking at what's the target loss ratio that we assume for the group. So target loss ratio typically is looking at that, okay, well, you've paid $100 in premium, you've claimed $72 on claim, so your claim ratio over here is 72%. For this industry, if the insurance company has made an assumption that 75% is our target loss ratio, then your 72% is here, you're good. That may mean that your premiums may either remain the same or they may slightly go up. But if your claim ratio is 82%, which basically means for $100 of premium you've put, you've claimed $82 in benefit, then you're kind of over the 75% target loss ratio over here, and your premiums will go up. what we do advise most clients on their benefit plans is that earlier on, when you put any group benefit plans in place for your employees, you will find that most people did not have glasses for a very long time, would have glasses. A lot of people would go to their massage, get the massage. A lot of people would go to their dentist, and you're really fortunate that way because dentistry is something that you control and those expenses can be controlled and minimized. We found there are certain dental practices which would do lab only for their employees. Sometimes it's also employees and their family, and sometimes it's also employees, family, and extended family. And yes, they've been really generous at doing that. But when it comes to group benefits, at time of renewal, we would highly recommend that you shop around. At the minimum, you may want to express your desire to shop around because renewals is sometimes a little art to it. It is not necessarily a science, and it's interesting sometimes that when we've used the language that we would like to shop around, and we've seen sometimes insurance companies come back and say, I think we could do a little better, and we've accommodated something better for you. So it's a free advice that you're getting today because it's a learning platform that please use the word. We may like to shop around, and you'll be surprised that that tiny line over there may actually help you get some discounts. Next slide. All right, health spending account. So health spending account is really fascinating. And this is an area where we've seen a lot of clients kind of attracted, kind of uh, yeah, perplexed, and they're like, okay, what is this plan? What does it do? How can we utilize this plan for the benefit of our for our organization and for our employees? And typically, what we find is that businesses are at a much lower tax bracket versus the individual. The individuals could be at a much, much higher tax bracket. So, is there a way of utilizing this lower tax bracket at the corp side to pay for these medical expenses without making it a taxable shareholder benefit or a taxable employee benefit for that matter? Is there a way to make it more generous? So that is something that we find. Now, how does this HSA plan typically works and how does it go? I kind of created a small animation. I'm hoping I did some justice over here to help understand, and I hope I'm on time in explaining all of this. Okay, so typically we have these medical expenses. We have employees and shareholders who have medical expenses. We set up a third party HSA administrator, and we have the corporation. So the corporation sets it up with the third party administrator. The third party administrator is the one which is dealing with the employees and shareholders. They are not talking to the company, they're talking to the third party administrator. The employees have medical expenses that they pay for, and those medical expenses that they've paid for, they typically get a bill or a receipt. They provide that receipt to the third party HSA administrator. Now, the HSA administrator typically would add on a cost. Typically, we find that cost to be about 10%. And depending on the administrator, it could be an annual fee, it could be a per claim fee. It just depends on who you signed up with. There's so many available out there. We are fortunate with the ones that we work with where we don't have annual fees and there may not be per claim fees. So we would highly recommend that if you are in that situation where you have those additional costs that you're paying, that you please get in touch with us. We may be able to help save you some money. So what does the third party administrator do over here? They are the ones who adjudicate the claim. That is their job. They register the plan with CRA. So as far as your plans being offsite and onsite is concerned, it's their responsibility to do that. They send you a bill. Okay, here's the claim that we've got along with our bill, along with our fees. Here's the total. The corporation sends them a check of for the total amount. They deduct their fees from it and then they reimburse that. The key element that you want to notice over here is the employees will always be out of pocket for the medical expense. But at the end of the day, they are getting their money reimbursed to them. They did not get the money from the corporation as taxable benefit. It came to them as a tax-free reimbursement from the HSA plan. This could be significant if we were to think, well, I have a $10,000 medical expense. I'm at a $250,000 tax bracket right now. My tax bracket is my marginal tax bracket is 53.53%. And if I have to pay $10,000, I probably have to pull out $21,000 from my corporation as taxable benefit so that I net $10,000 and I pay the $10,000 expense versus I set up an HSA plan that $10,000 is a $12,100 claim from the HSA provider to the corporation, and I get $10,000 tax free. From the corporation standpoint, the corp spent 12,100 versus $21,000. That is the power of a health spending plan. That is why these plans are so popular, and that's why we talk to our clients about these plans. Now, there are few types of HSA plans that are available. There's a fixed contribution type where you have to contribute every month into these plans. There is also a cost plus type where you don't necessarily have to contribute anything into the plan whatsoever. And at time of claim is where you go to the third party provider and make a claim. They tag along a cost and they send it to your corporation. So it just depends what works best. Sometimes for some employers with smaller teams, it may work best to just go with cost plus. For certain organizations, a fixed contribution may make more sense. You may want to talk with your RM on these, and we'll be able to help you on which one makes more sense for you versus the other one. It can be customized. One of the important aspect is that, okay, well, we have dentists, we have dental hygienists, we have dental assistants, we have our admin staff, we also have our IT staff. Now we want to treat everybody respectfully, and we want to ensure that there is a right reimbursement level at different levels. Now, I'm not saying that everybody has to be treated equally, but everybody has to be treated fairly. That is just the point. And at time of claim, even CRA is kind of cautious that your claims are reasonable. So if an individual is making $50,000 a year in income and you submit a $500,000 claim, that probably is not going to go very, very good with CRA. And even with your third party administrator, they would step in and they would let you know, okay, this is going to be offsite. But if an individual is making $100,000 a year and the claim is $50,000, $60,000 a year, much less chances of those type of claims being challenged. And that's where your classes of coverage help. Newer plans have options of catastrophic coverage. So because earlier when we spoke about this element that, well, there's no insurance element to it. So what happens if an employee comes and puts $100,000 claim? I mean, it could pretty much have a disastrous effect on the business because the business is now on hook to pay $121,000 to the third-party administrator. So there is an option of including a catastrophic coverage, which actually kicks in about $2,500 worth of expense, and it reimburses up to $125,000 per year per person. So there are those kind of options available. There are other options that are also available these days. There is something called as a VIP Universal International Health Insurance. Now, we all know the current circumstances and the current medical situation that we have in Canada. I mean, we have some of the best medical facilities available in Canada. And we are so fortunate that we have all these services available to individuals where they don't really have to pay anything. And we're so fortunate that we have, because most other parts in the world do not have that. But having said that, it's backlogged. There are wait times. There are surgeries that have been postponed more than once today, not just once, more than once. And it is getting challenging to get treated. There are options that are available where you want to get treated and you want to get treated at Mayo Clinic, Cleveland Clinic, or the best places in the world. You don't want to wait because your health is important to you. There are options that are available that can be part of a HSA plan that would not only find those places for you, make arrangements for you to travel, but also go and pay for them. So they'll take care of all of that aspects for you altogether. So with that said, come back to our third question that we have. Which of the following is the most generous or provides the least restrictions on the amount of medical claims? So the most generous, is it the health spending account? Is it your group benefits? Or is it your health and dental insurance? All right, Jake. Almost a vast majority of individuals got that right. It's almost 90% of that of you got it right. It's the health spending accounts. Actually, there's very little restrictions on the amount of claims that you can put towards um, health spending account unless you've set it that way. Thank you for helping, Jake. So now you're gonna. Oh, geez, I've been talking too much. Probably need to rush this one. So, critical illness insurance. I mean, we all know uh, the impact of cancer, heart attack, stroke that happens on individuals, on families, how financially draining it could be, and how difficult it is for them to go back to work and start life all over again. What this insurance does is that pays you a lump sum benefit so that you can focus on recovering, getting better, and that you can provide yourself the liberty that you can actually go seek medical advice in the right place, and you have the finances to do that as well. In a lot of cases, critical illness insurance just provides you a benefit, and they don't ask you a question what you do with the money. It's totally up to you. So if you want to get treated at the best place on earth, by all means, go for it. They would totally help you out. Now, in terms of this plan, the key aspect is that the benefit is paid on a definitive diagnosis of covered illnesses. So it does not mean that it will cover absolutely every illness out there, but it will cover those illnesses that are specified as covered illness on the plan. This plan can be customized to pay in the event you get sick with the illness, in the event you pass away and you never got sick, or in the event that nothing happened to you and you live past the plan expiry date, or you want to just surrender the plan. In either of those four cases, a critical illness insurance can be designed to pay for a benefit. I'm sorry for the lack of time. I'm going to quickly skim over which illnesses it covers. Most people understand cancer, heart attack, and stroke. Those are your top illnesses that account for over 85% of all of the claims. In terms of plan design, there's something called as basic, which only covers you for cancer, heart attack, stroke, and coronary artery disease. There is a comprehensive plan, which basically covers you for all the illnesses that I spoke about. In terms of the duration for the plan that you want to have, you can have a 10-year term and a 20-year term and a 65-year term, or to age 75, or a permanent. So there is a wide variety of coverage durations that are available. When you're starting off young, you need the insurance and it's going to cost a lot of money. Term 10 would be your option. Once you established everything is in there in the right place, you probably want to look at something which is T75 or a permanent insurance, because trust us, the stats are really staggering against us when we talk about illnesses like cancer, where if you look at the stats which Canadian Cancer Society gives out, which pretty much says, there's about 45% chance of us developing cancer through our lifetime. So we know this is something that is probably going to happen to us at some point of time. In terms of coverage amount, most insurance companies these days provide up to 2.5, some provide up to three, some provide up to $3.5 million worth of coverage. It just depends on your circumstances. In terms of riders, I think I just spoke about this one, so I'm not going to repeat, but there is an option to get return of premiums in the event you pass away, or in the event the plan expires, or in the event you plan not to continue with the plan. So there are those options that are available. In terms of planning aspects of this, I would highly, highly recommend that you work with an advisor or with your relationship manager to kind of understand, okay, how much do we need and what type of plan do we need? What I would normally suggest is that, please, if you're looking at this plan, consider it not just for yourself, but also for your spouse and your children. Because at the end of the day, what we see is that if a working member has been contributing over 75, 80% of the household income, however, somebody in the household is now sick with a serious illness, then they are not able to perform all of their duties properly by themselves, because it's really very difficult to work when your kid is sick or your spouse is sick. So it will help to get enough revenue in the house, enough cash flow in the house, so that we can ensure that, okay, we can now focus on getting better. Return of premium on death is an option that you may want to consider in the event you pass away. You want something to be there. Now, keep in mind the underwriting of critical illness insurance is a little more involved. So it's usually recommended that you look into this product when you're in the age band of 30 to 50. Not that it doesn't apply beyond age 50, but it's just that it gets harder and harder to claim for, because the likelihood of that one keeps getting higher and higher. Please look for standard contracts. And I can't tell you the importance of this, because we found that there are insurance companies that will have exclusions. There is an exclusion called failure to seek medical intervention that could actually exclude a payout. So we know in terms of many serious illnesses, I mean, their symptoms may actually show up as not really very serious symptoms. So, for example, um, blood pressure, for that matter, high blood pressure, hypertension, dizziness could be a symptom for that. And we know with our busy lives, many of us ignore symptoms. And if that high blood pressure goes untreated, it could lead to other things. It could lead to stroke. If that was a failure to seek medical intervention, then probably a benefit is not payable. So highly recommend to kind of keep an eye on this. So quick question over here. What is the difference between a disability insurance and a critical illness insurance? So if you heard me before, does disability pay out a lump sum amount, or does it pay out a income benefit? How does it differ? I'll totally leave it totally to you. All right, Jake, what's the answers that we got? All right, 92% of you guys have got this right. So I'm so glad that we are an hour and 15 minutes into the presentations, and we still have so many people who are so attentive. So thank you for this. All right. Introduction to life insurance. Again, this is just merely an introduction. We're not going to do a deep dive into life insurance today. It's just an introduction to life insurance. Why do we need it? I think we all know it. It's the ultimate risk. You pass away, you have a family, you have a business to run, and there are debts. We just want to ensure that we're able to cover all of them. There are key attributes of life insurance that make it a really powerful planning tool. Firstly, the fact that the death benefit is tax free. The second benefit is that it bypasses probate. So the giving is totally private and it goes straight to the named beneficiary. There is an element of life insurance which has got to do with the tax sheltered growth of policy reserves. So the values which are inside an insurance contract, as long as they're growing under the MTAR line, could be tax sheltered. And for a corporation, it brings in an additional benefit that it has an ability to create a positive credit to the capital dividend account. And this is a very strong planning tool that helps businesses to extract tax-free capital dividends for their surviving shareholders. So this is certainly an option that's available that could be used. So why do most people use it? I think I briefly touched base, but income replacement, to ensure that the income that you're making, your household relies on that income, and we are replacing that income. Of course, covering debt sometimes becomes your first priority, that we want to ensure all the debts are covered and those things are taken care of. Estate protection is the other side of it, and we will talk more about this when we go into our next presentation, which is going to come in Q1, where we talk more about estate preservation and life insurance deep dive. But life insurance is a very, very strong tool for estate protection, typically for the reason that it provides a tax-free benefit and helps in equalizing the estate property among different uh, beneficiaries. Business succession, key person and contractual obligations. Sometimes it's very, very important that you have insurance inside a business, typically because you have a succession plan in place. You have somebody who's going to be taking over your business, purchasing the business. If that's the key person, we want to make sure that they're protected. Protecting key assets and contractual obligations. Sometimes we've seen families owning a family cottage that has been there for generations in the family, and you want to protect that asset remains in the family. You want to ensure you have liquidity to pay down those capital gain taxes in future which may arise due to deemed disposition, and we'll talk about it in our future presentations that we'll do. Charitable intent insurance is really, really very big on charitable intent. Primary reason is that if you want to give a charity $100,000, then using insurance, you're not paying $100,000 to give charity $100,000 of benefit. There are significant other benefits of using insurance towards charity, and then there are elements of living benefits that are also there. Broadly, life insurance is classified into two types. There is term insurance, which is temporary, and there is permanent insurance, which is there for you for the rest of your life. Term insurance typically is an inexpensive coverage. Your premiums are set for a fixed duration. So in this example that you're seeing on the screen right now, it's a 10-year term. Your premiums are fixed for 10 years. They go up at the end of 10 years, they're locked again, and then they go up again. Now, the newer insurance that are available in the industry these days, they have premiums which will be locked in for next 10 years, but at time of renewal, they don't go up for next 10 years. They go up slightly each year at the end of 10 years. So every year it will go up, but it is not as dramatic as it used to be. We can customize it. We can get a term insurance for 5 years to actually 50 years, all depends on the situation. These plans typically renew, and they renew at the end of the duration automatically, but they're also convertible. So you can always switch between a term insurance to a permanent insurance without providing any medical evidence. And sometimes it also provides you this term switch privilege, which, by the way, gives you an option to switch it from a 10-year term into a longer duration term if you want to. Most typical uses of term insurance have got to do with short and medium term duration liabilities and responsibilities, debt coverage, income replacement. So a lot of time, vast majority of your first insurance purchased would be your term 10 insurance. Now, we've seen creditor insurance and mortgage insurance. I'm not going to touch on this slide for the reasons of times, but I'm quickly going to walk you through permanent insurance. So when we talk about permanent insurance, you're talking about something which is there with you for the rest of your life. Your premiums are fixed. They don't change through their life. These insurance may offer you something called as cash surrender value, which is basically a policy reserve. So if you want to surrender the plan, you have access to this, or if you want to take uh, if you want to take a loan against it, this is the asset that you could leverage against. There are sometimes reduced paid up insurance. So there is an option where you don't need the insurance and you want to kind of have you can't pay for the insurance, but you need some insurance in place. So there is an option that you can exchange the policy for a reduced amount. Uh, Policy loans we've talked about. There are times where you have participating whole life, which can give you policy dividends. So basically, when we're looking at permanent insurance, the most common part type that is talked about in the industry is what we call as term to age 100. Basically, a fixed death benefit, fixed premium. There's no value to it. Flat, vanilla, there's nothing much, but it's insurance for lifetime. There's another type which is called non-participating whole life insurance, which basically does something similar, where you have fixed premiums and you have fixed death benefit, but you could pay it off in 10 years, 20 years if you wanted to. These plans also come with cash surrender values and reduced paid up insurance. There's an element of policy loan that's available. So in the event there are cash flow issues and you can't fund the policy, then you can take a policy loan and that will be able to pay the premiums of the policy. Both of these plans, the common theme is that the death benefit is fixed, the death benefit doesn't move. The next type of plans that we have is where we have growing death benefit. So growing death benefit basically is where there are values in there. There are two types broadly into this, which is a universal life insurance and a participating whole life. In both of these plans, you have the ability to pay a base premium. You have an ability to pay more than the base premium that you're putting in. In a UL, or a universal life insurance, you have an option of directing where that investment goes. So whether you want to direct that investments in a GIC, in an index fund, in a segregated fund, in a mutual fund, the option is available. Certain insurance companies will provide you lots of investment options that can range up to 400 investment options, and certain insurance companies would limit it to probably 4 or 5 investments. So it just depends on which insurance company that we picked. Participating whole life, on the other hand, is totally different. It's a totally hands off investment mechanism where the insurance company is managing the pool of investment for all of for all of the policies which are of the same type, issued in the same class and in the same duration. So they create a per account and they work on that one. The whole life policy typically has a concept of vesting. So once you have received a policy dividends and the values have gone up, they get locked in over there. They don't change. This is a significant difference between a whole life and a universal life, where the values can actually change on a daily basis. It just depends on what the underlying investments are doing. So that's other option that you have out there. Now, true or false? When planning for insurance, life insurance is the only insurance that should be planned for. Simple true or false question. And you see that all the time. Now that we've seen that there are so many living benefits, there's a true or false. Is life insurance the only insurance? And that's an awesome answer. Everybody got that right. Life insurance is not the only insurance option. There's other insurance options that are more significant. So now that we've done this, let's look at the different insurance solutions at different stages. And I'm quickly going to go through it so that we can answer the questions. Again, I'm not saying that the stages that of life that I'm going to talk about will fall exactly the same way for everybody. It does depend. Every individual is different, and it could mean and work out totally different. But when you're starting out young and you're starting out new, first thing that you're concerned about is your income. You're worried about your medical expenses. You're worried about your student loans because you may still be carrying them. You may be worried that, well, the team that I've joined or the practice that I've joined, they don't really have any benefits, or maybe I'm working as a contractor over here, or maybe I'm working as an independent contractor and I'm not eligible for benefits altogether. What kind of insurance options should be applicable for me? Probably want to look at some graduate disability insurance. Probably want to make sure that you have your own standalone disability insurance. If you're incorporated, HSA may be appropriate. If you're not incorporated, then for health insurance, you may want to see a personal health insurance altogether. If you have debts and you have your parents pay for that, they are on the hook for the loans that you took for your studies. You probably may want to get some term insurance in place to ensure those debts are covered. When we talk about new family, typically what happens is that you have mortgages and you have personal debts. You have income replacement needs because your spouses are dependent on your income. You have kids now, you're worried about medical expenses, and you may not have adequate coverage at work. In those events, you typically want to plan for some term life insurance, some disability insurance, some critical illness, and some health insurance or HSA, depending on what your situation is. If it's a mature family, and does happen, and again, I'm not saying that this stage of life is happening prior to another stage of life. I'm just saying this is a stage of life. It can happen at different times for different individual, because some clients may go from a small family straight into a established practice. Some and may not have that much growth on the family front altogether. But sometimes we do see that families grow. They have more kids in the family. The houses are small. The first house that we move into is smaller for our needs, and we have to move into a bigger house. So There may be a need for covering bigger debt, or there may be a risk of bigger debt. There may be a higher income replacement need because now one spouse has to be 24/7 taking care of the kids, and the other spouse is really busy with the dental practice, that we really need to make sure that there is a higher income replacement that is there. We want to make sure there is medical expenses taken care of if we don't have adequate coverage at work. So typically at this stage, you would see personal term insurance taken into account. Disability insurance again has to be enhanced to ensure that your income is protected. You may want to ensure at this stage that you have critical illness for the entire family. Health insurance or HSA, if you're incorporated, those are the ones that you want to do. Now, at time of dental practice purchase, typically you would find that your lender would tell you that we are providing you a debt, but it's contingent on you getting insurance. So please keep in mind that you may require life insurance for that. But there are business overheads, there are business partners sometimes, there are staff that wants that has to be retained in the organization, and we may need some group benefits. There may be benefits in place where you're purchasing, or they may not be. That is something that you have to look into, and probably you may want to look into getting something like this. So this is typically the time where we do see business owners get disability, business loan protection, and overhead insurance protection. These don't come much earlier unless you own a practice, is when they typically come in. Now, when it comes to established practices, for established practices, you want to make sure that your key person and your business partners are taken care of. You have sufficient group benefits in place that will retain and attract your employees and potential employees, and that your overheads are covered and your business debts are covered. There are the other aspects, and I'm so sorry, I'm running out of time. So I'm just going to quickly skip this because I want to take those questions up. But I would highly, highly recommend that if you have a question regarding insurance, then please reach out to your relationship managers. We are all over here to help you, to work with you, and there are aspects of insurance that may apply to you, that may be unique to you. So we are happy to help. And with that, I would come to the Q&A session over to you now. And I apologize, I took too much time. Sorry about that, Jake. Could we please go into the Q&A session?
Well, well done, Sanjiv. I mean, there's obviously a lot to it all, but let's get to a couple of the questions here and see if you can help out these folks.
Sure.
The
No
first
problem.
question is actually quite detailed and gets into, I guess this is life insurance, presumably a universal life. So can life insurance be utilized as a tool to pass down estate to beneficiaries with minimum or no tax? For example, using the professional corporation to own life insurance and to pass it through to the estate via the capital dividend account. Should a person just pay the minimum premium or the maximum, right, in order to maximize the estate transfer? And then there's other questions about the adjusted cost base of the plan and how that affects the strategy.
I think this is a really involved question, and I would highly recommend that you directly reach out to a relationship manager on this question. Certainly, life insurance can be a very, very strong tool to pass down wealth to the next generation. It is a tool which can be utilized to move tax-free capital dividends from the corporation to the individual. In terms of how much asset needs to be moved down from the corporation to the individual, depends on individual circumstances. So I would not make a blanket statement for everybody, but I would highly recommend that we reach out to your individual RM, and we'll help guide you on this question.
Yeah, very good. Next question, it's relating to the group benefits. Would you agree that a 50-50 cost sharing of the group benefits premium with the staff, with the employees, can have the additional benefit in that those employees who have better coverage through their spouse will not take part in the plan, thereby saving costs for the employer?
Well, it's actually an excellent question. And I have personally seen this happen where employees, when they see that there is a cost split, they don't really want to participate. The, although it is a important aspect for the business for cost control and you may want to do that, but you also want to keep in mind that most group benefit providers will mandate a 75% participation rate into the plan. So yes and no, it is actually a very good mechanism. I highly believe in it because that puts the individual's skin in the game. So your employees, I mean, they're not only claiming, they know they're paying for it, so they would want to be careful. So yes, it is a good tool.
Excellent. I think we have time for one more question here.
Sure.
It is, I'm a university professor and a dental specialist. I find that my group benefit through the university is better than my wife's health spending plan, and she is a physician. So do you find sometimes the group benefit plans can offer more benefits than a health spending account?
Okay, so the fact of the matter is group benefits is certainly an option that your corporation can set up in the way that works best for your employees. Having said that, the health spending account is a lot more flexible, and I would highly recommend that this should be taken with the provider it is set up with, because in most cases, to give you an example, there is actually no limit in terms of a procedure or in terms of an expense on the HSA aspect for an expense. So, for example, if you're talking about dental, most plans would have $1,500 or $2,000 at max as benefit. And you can set up an HSA with $10,000 or whatever $1,000 you want to set it up as. So in that regards, it just depends. Sometimes there are HSA plans which are monthly contribution based, where this is typically the problem because, well, we are only contributing $2,000 a year into the plan. So then you can only claim $2,000 into it. So if you're going to if you want something which is a lot more comprehensive, then you probably want to move from something which is a monthly contribution based to a cost plus base where those limitations are totally taken care of. And now sky is the limit. As long as your corporation has sufficient capital to pay for it, you have it.
Excellent, excellent. Thank you, Sanjiv. That was definitely a great overview of the various types of insurance solutions that are available. And I would like just to add that your knowledge and passion for this topic is very evident. But from your comments tonight, it's clear there is a wide variety of plans and issues to consider in finding the right insurance solution. I think the key takeaway is to work alongside a trusted insurance advisor who understands your situation, can identify and prioritize the most important financial gaps that need protection, and to find an appropriate solution that fits within the budget. So for those that want to get in touch directly with Sanjiv, I would suggest you send an email to sanjiv@tmfd.ca. That's sanjiv@tmfd.ca. So today's webinar closes out the presentations for this year, but our next presentation is scheduled for Monday, January 23rd from 7 p.m. to 8:30. Our guest will be Cindy Mark of Benchmark Practice Management Consulting. We're very pleased to have Cindy join us to share her knowledge and advise practice owners on how to maximize both the production and the potential of a dental practice. Guests may register for the upcoming event on the TMFD website under the Academy page. More information will be posted in the days ahead. A brief reminder that participants tonight will receive a free copy of the book, The Financially Independent Dentists. And if you have any questions about your personal circumstances, feel free to send an email to info@tmfd.ca. Finally, a reminder that the PACE CE certificates will be issued within 2 weeks of this presentation. As we close up this evening, I'd like to thank our speaker, Sanjiv Tidke, for his valuable experience and insight, and to Jake Giesler for running the show. And thanks to you, our guests. It's been really great to share this evening with you. We hope you found it valuable. Thanks again, everyone, and have a good night.
Thank you.
Thanks, everyone.